Hey, enthusiasts! Welcome back to our Indian stock market series. If you haven't watched part 1 yet, I highly recommend you check it out first. It lays the perfect foundation. Today in part 2, we're diving deeper into the heart of the stock market, the equity market. Grab a notebook. You're about to learn a lot in a simple, clear way. Let's get started. What is the equity market? Let's understand it with a simple, relatable example. Imagine you start a bakery. In the beginning, you invest your savings to buy ingredients and rent a shop. Business booms. Customers love your cakes. And now you want to open 5 more stores across the city. But you need more money to grow. You have 2 options. Option 1, take a loan from the bank. Option 2, sell a small piece of your bakery to investors who give you money now and become part owners. This second method of selling ownership is called equity. When businesses all over the world sell ownership and investors buy it, that creates the equity market. In simple words, equity market, where businesses sell part of themselves and investors become owners. 2 parts of the equity market. Primary market. This is where companies raise money for the first time by offering shares to the public. This process is called an IPO. Example, in 2022, LIC launched its IPO. People could buy LIC shares directly from the company. Why do companies do an IPO? To raise funds for expanding, paying debts, buying new assets, hiring more people. Basically, to grow. Think of it like opening the gates for public investment. Secondary market. After the IPO, shares start trading between investors, not between investors and the company. Example, you buy Infosys shares from someone selling them. Infosys doesn't get the money. It's like a second-hand car, market ownership changes, but the company remains the same. Types of equity stocks. Stocks are grouped based on the company's market cap. Market cap equals total value of the company's shares. Large cap stocks. Market cap above 50,000 crore rupees. Examples, Reliance Industries, TCS, Infosys, HDFC Bank. Think of them as giant oak trees, strong, rooted, and stable. They offer steady, safer returns. Perfect for beginners or those who want less risk. Mid-cap stocks. Market cap, 10,000 crores to 50,000 crores. Examples, Zomato, Dixon Technologies, Voltas. Mid-caps are like teenagers growing fast, but can stumble. They can deliver higher returns than large caps, but are more volatile. Small cap stocks. Market cap, below 10,000 crores rupees. Examples, Nazara Technologies, Ease My Trip, Tejas Networks. Small caps are like energetic startups, big dreams, big risks. They can become multi-baggers or crash dramatically. Blue chip stocks. Reliable companies with a long history of success and strong financials. Often, but not always, large cap companies. Examples, TCS, Infosys, HDFC Bank. Blue chips are like trusted brands. They keep growing steadily. They may not give explosive returns, but they offer peace of mind. Penny stocks. Very low-priced stocks of tiny, often unknown companies. Penny stocks are like lottery tickets, thrilling but extremely risky. Most beginners should avoid them because you can lose everything overnight. Quick recap. Large caps equals safe giants. Mid caps equals growth potential plus some risk. Small caps equals high risk, high reward. Penny stocks equals extreme speculation. How equity trading works. Delivery trading. You buy shares and hold them for days, months, or even years. Delivery trading is the foundation of wealth building. It's investing, not gambling. Intraday trading, buy and sell on the same day. Example, buy Infosys at 1,500 rupees. Sell it 1,515 rupees within a few hours. Intraday is exciting, but very risky. Most beginners should avoid it until they gain experience. Important order types. Whenever you trade, you choose how your order is executed. Market order, buy, sell immediately at the current price. Limit order. Set a target price. Trade happens only if the market reaches your price. Stop loss order. Preset a safety price. If a stock's price drops to a certain point, it automatically sells to minimize losses. Always use a stop loss. It's your financial seatbelt. Trading hours. Indian market timing, 9:15 a.m. to 3:30 p.m., Monday to Friday. Equity investment styles, growth versus value. Growth investing. Invest in companies expected to grow quickly in the future. These companies reinvest profits to expand rather than giving large dividends. Example, investing in TCS in its early growth phase. Value investing. Invest in strong companies that are temporarily undervalued. Find solid businesses available at a discount. Example, buying ITC shares when the market undervalued them due to short-term problems and watching them rise steadily later. And that's a wrap for part 2 of our Indian stock market series. You've just learned the basics of the equity markets. In part 3, we'll dive into the futures and options market, an exciting and more advanced area where you'll learn how professional traders operate. So don't forget to like, subscribe, and press the bell icon so you never miss a lesson. And I'll see you in part 3.